Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Max Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mandeep Mehta, Chief Financial Officer, Max Financial Services Limited. Thank you, and over to you, sir.
Thank you. Good evening, ladies and gentlemen. Thank you for being part of Max Financial Services earnings call. My name is Mandeep. I'm CFO for Max Financial Services. Before proceeding with performance highlights, I'd like to introduce my other colleagues who are with me on this call. I have Mr. Prashant Tripathi, MD and CEO of Max Life, and Mr. Amrit Singh, CFO and Head of Strategy for Max Life. On a consolidated basis, our revenue excluding investment income are at 14,160 crore, growing at 21% in 9 months in FY22 in the most challenging business environment. As you are aware, the COVID has put in some specific business challenges. The consolidated pre-tax profit for 9 months FY22 is at 236, lower than last year, primarily on account of the provisions or the reserves created for pandemic and certain one-offs that were recorded in the same period last year. Moving on to the key business highlights for Max Life. Max Life individual AP has grown by 23% to 3,700 crores in 9 months of financial year 22. Market share is at 10%. On 2-year CAGR basis, Max Life grew by 16%, while private industry grew by 11%, achieving Q3 growth of 28%, driven by growth across channels. Proprietary channel grew by 28% in Q3 and 15% in 9 months. Strong growth of 27% in banca channel has also been recorded in this period. NBM for period ending December stand at 25.1%, an expansion of 18% over a period from financial year 16 to financial year 21. And VNB grew at 20% year-on-year basis at 942 crores. For last 5 years, the VNB has grown by 27%. Max Life MCEV grows 18% year-on-year at 13,412 crores. MCV on operating basis has grown at 18.1% annualized, which increases to 19.2% after excluding one-off impact of COVID-19. Including non-operating variance, ROEV is 18.2%. Gross premium grew by 21% to 14,415 crores, and renewal premium grew by 19% to 9,128 crores. 13-month persistency improved by 270 basis points to 85.3, and 61-month persistency by 55 basis points to 54.2. Death claim run rate has come down since September 21 after peak in July 21, and unutilized pandemic reserve at the end of December are at 208 crores. Individual sum assured of new business has grown to 17% in Q3 of FY22, led by growth in protection. Solvency surplus of over 150% of RSM is at 1,842 crores, with solvency ratio at 207%. AUM at the end of December 21 is at 1,202,471 crores, and with this, Max Life is now the 4th largest manager of private life insurance AUM, par fund size more than rupees 52,000 crores. We continue to maintain our rank of 18 in great places to work in FY21, which is we are also at rank 55 among the great places to work in Asia. And continuing from FY21 survey that we reported earlier, we are ranked number 1 in customer loyalty as well. During the quarter, Max Life has also received IRDAI permission to set up a new company for pension fund management. and that formation of that company is underway. Next Life has also launched a new power product called Smart Wealth Income Plan in Q3 of FY22. We also conducted India Retirement Index study in partnership with Kavi Insights. India's retirement index stands at 44, health and financial preparedness a key retirement concern amongst Indians. MLIC has formulated and launched a ESG strategy comprising of 4 pillars, which is work ethically and sustainably, care for people and community, financial responsibility, and green operations. Detail of this ES journey is included in the investor release deck. To sum up, Max Life will continue its trajectory of driving strong shareholder outcomes with Axis as a new JV partner. Good progress made on 5 pillars of Max Life strategy, which is predictable and sustainable growth, product innovation to drive margins, customer centricity across value chain, digitization and analytics, and as foundation and augmentation of human capital as mentioned earlier. On that note, I'll hand over to the moderator to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may. Participants are requested to use handsets while asked questions. We would also request participants to limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you so much. Good evening, sir, and thank you for the opportunity. So, a couple of questions from my side. First one was on the product mix. So, sir, for this quarter, what I see is that a larger contribution has come from ULIP. Now, is it the only factor that has impacted your VNB margin as given in the change in mix, or is there anything else to read into that? And then, in addition to that, sir, on the traditional side, as you mentioned, with the launch of the PAR product and also the longer variant of the Smart Wealth plan, what is the traction that we are seeing now with that? Because those were, I think, launched towards the end of the quarter. So that would be my first question, sir.
Thank you very much for your question. This is Prashant, and thanks to everybody for taking out time. We recognize that it's Friday at 7 o'clock, so we really appreciate your interest in our luncheons. Your observation is right. I think if you recall my guidance last quarter, we did speak about being in the range of 25, 26. We are in nearabouts, and it was very important for us to recognize that there is a balance needed between sales momentum, sales growth, market share, and product mix, and we took that tactical call. Also, if you notice, the change in product mix predominantly is in our partnership channels, Axis Bank. And at the end of the year, typically there are contests around this. Year-end was about MDRT, and that contest actually also resulted into higher share of ULIP. But if you are asking the question about why we are lower than last year on new business margin, that's the only reason why we are lower. The product mix was a bit traditional focus, more non-par focus last year, and this year it is ULIP mixed. But the good part is we saw a lot of traction on our new sales. Our new sales are up 28%. Our proprietary channels have also grown 28%, which is really fantastic. So both relationship and partner own channels grew 28%. That was quite good about the quarter. On the question that you asked about margins, Amrit, do you want to take that?
Yeah. So I think Prashant did answer that the decline in margin profile is largely because of product mix. But if you look at the sub-segment level, actually our margins have held steady, whether it is non-par savings, protection, or UL. In fact, for the Q3, we have seen an improvement in the margin profile of our participating business, given the new launch of the product that we saw for ourselves. This product actually has had a very successful launch. We crossed 100 crores in the shortest time ever for any product launch that we have done for ourselves. And you can see, the increase in par mix that you can see, which has kind of come through, and the growth in par business continues to be very robust in this particular financial year.
Sure, sir. Any comments on the Smart Wealth longer variant also? Any additional traction that you are seeing from that side?
So I'm assuming you're referring to the participating Smart Wealth income plan that we have launched, which actually has a longer variant. Are you referring to that?
I was referring to the guaranteed product, guaranteed side.
So if the question is that on non-par, again, we have, it's a very healthy mix of both long income and short income. So it's a very healthy mix. This product has now been alive for over a year and a half kind of a period actually. And we have been doing quite well on this particular product. We just added a couple of variants which were more in the 7 and 8 pay kind of a variety, which is more, I would say, mid kind of a thing. Those have also been adopted and embraced quite smartly within the channel.
Okay, all right. So that's helpful. Another question was on the distribution, sir. If you could share the the contribution of Axis Bank in the AP for the 9 months or Q3.
So it's around 67% is what will be the Axis Bank's contribution.
Okay, sir. Okay. All right, sir. If I may allow to squeeze in one more question about the individual protection. So your plans on the pricing going forward on this segment, and if you can throw some color on the retention levels that you have on these products.
On protection. Yes, so protection, actually, we took some calls in the first half of the year, really driven by what was happening during Delta variant, and took some call around our underwriting norms. That, of course, caused our retail as well as group protection to go down, and that's quite well mentioned. But what we have done is now we are increasing the proportion, and as I have been saying, this is a very strategic area for Max Life Insurance. We do want to grow, and in Q4 we have started to grow at total protection level. We have started to grow as every month passed on the retail book also, and we are going to look at we have been in discussion with reinsurance partners as time has passed. Of course, there are some increases which are anticipated because the insurance rates will go up. This is their experience, and we are out looking a price increase. Right now, as things stand, we are in negotiation with them, so it will be hard for me to tell you exactly what number, but it will be a nominal price increase that we're out looking. That price hike should come as soon as we finalize our negotiation with our insurance partners. We are going to protect our margins, so whatever increase comes our way, we are going to pass it on through the price. As far as retention is concerned, that's a normal trend which is happening. I think out of the experience that COVID posed to everybody and to the insurance partners, there is a requirement for Max Life Insurance, like all other life insurance companies, to retain more. I'm expecting that our current retention, which is today at around 20 lakhs, that will go up. I think it will go up to more in between 30 to 35 lakhs. So that's the retention that we will have, and we are quite pleased about it because this is a strategic area. We have a lot of learning behind us, so in a way, it's a very positive move because that creates better alignment of purpose as well as better understanding between the reinsurance provider and the life insurance company. That's the extent of price hike as well as retention that we're out looking.
Sure, sir. That's very detailed. Thank you so much for the explanation. I'll join back in the queue. Thank you.
Thank you. Request participants to limit your question to 2 at a time. The next question is from the line of Madhukar Lakha Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening. Thank you for taking my question. First, on the non-par business and the business mix that can shape up. So what I'm understanding is that the non-par business is now getting very competitive with other players offering competitive IRRs. And margins have sort of come off. That's what some of the feedback that I have got. So what has been our experience? Second is in an environment where short-term rates sort of rise and you see a flattening of yield curve. Do we think that we will be able to sell the same level of non-par protection that we have been doing, for much of this year? Or do you think that the mix will again sort of start gravitating towards par and ULIP? And last question, just sort of on the COVID hit. Can you tell me what the COVID hit has been for 9 months, the hit in the P&L? Yeah, those would be my questions. Thanks.
Hi, Madhukar. Thank you for your questions. I'll take this, Amrit. Firstly, non-par margin profile for us, YTD actually has improved. And even in the last call, we had indicated that last year we had a new launch of the product, which has now run full cycle. So on a YTD basis, the non-par design product actually has improved for us. Now, taking a cross-section of Q3, the margins are stable as compared to last year Q3. So this summary that you said of, there is a shrinkage of margins, we haven't experienced that. And also you will remember that a non-par design is a mix of many things. You have various income points, various premium payment times that you have, which you can kind of play with and optimize for ensuring that the margin remains protected. So that's what has happened in Q3. Now, coming to your question around what's the movement on the spreads effectively, let's say the short term versus the long term. I think so far we monitor this very closely. It is an important pricing decision for us of how we kind of moderate pricing and consider variance. So far, we have seen, in fact, the long term move faster than the short term. Short term has also increased, but the increase of long term is higher. So it is so far supporting us. In future, obviously, India, historically, the yield curve has been more flattish, and that's how it used to be before COVID era. And as and when that happens, I think a couple of things happen. Firstly, an increase of interest rate also gives you an opportunity to increase because, the margin sensitivity is that if increase goes up, this actually helps us. So we will take the right call of how to moderate this particular number of, where the IRR can move up and down. That's a moderation that we'll do, whenever the curves move in that particular direction.
And Amrit, just one thing, sorry, do you think the supply of FRAs can get impacted? Because if, let's say, the yield curve flattens, then it would be less attractive for the banks to write that many FRAs, right? Because the spreads for them would reduce. Is my understanding correct on this?
The lock-in FRA rate that will come to us will become lower. It does. From their attractiveness perspective, obviously there is a difference between the short and long. So just that the FRA rate that we lock in or we get for ourselves potentially can come off a little bit. The spread that we are getting over GSEC can come under a bit of a pressure for us. And that's how you offset it by offsetting the IRR of the customer.
Right. Understood. Go ahead on the COVID thing.
On COVID, so look, we don't disclose specifically COVID deaths and COVID values separately. We took a 100 crore P&L impact for beefing up the provision last quarter, which we're aware of. Apart from that, we have not done anything in this particular quarter with respect to COVID. And our closing position on provision sits at 208 crores.
208. So the additional for 9 months is 100 crores on the P&L.
That's right.
and the closing is 208. Okay, thanks. Thanks a lot.
Madhukar, when we look at our position and the types of claims that we're receiving, notwithstanding any other variant coming our way, with how we see Omicron, I think we are sufficiently provisioned, and I don't see any risk to our balance sheet unless a new form of coronavirus comes our way.
Understood, sir. Thank you. Thank you. And all the best.
This 208 does not include IBNR. IBNR is separate for us. 208 is clearly earmarked for pandemic provisions.
Understood. Yeah, that I understand. Thank you. Thank you.
Thank you. The next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Just wanted to understand our protection business broken down into ROP and pure term, and the retentions, what you are trying to highlight that it will increase to 30 to 35 lakhs will be applicable to both the products in the same way, or you will have a differentiated approach with respect to ROP and pure term? That's my first question.
Yeah, I think it gets applied to some assured, so I suppose it will get applied to both forms.
Okay. And what would be our ROP contribution to the total term, whatever we do right now?
About 1/4 of total.
Oh, okay. And just the second thing which I wanted to understand is that the new power product in general, given we always were good in power, that new power product will come with a better margin profile because it's an income plan. Will it come with a better margin profile compared to the existing power we had? So within the power, it will be margin accretive?
Yes, it is. Thank you for highlighting. Yes, that's correct.
Okay. And finally, one last one, if I can squeeze in. If 67% is the Axis Bank contribution, then if I do a back calculation, it seems that the non-Axis Bank has declined sharply in the 9 months, around 25 to 30 odd percentage. So just wondering which channel.
Let me just interrupt you here. I think your 67 was, I gave you a Q3 view. 9 months if you've done, then the number is 65. So.
Oh, okay. Fair enough. Then probably right. And finally, on an annuity business, just if you can put an update on that, because every player has become decently very aggressive with annuity, and we are little behind there. On the scale of how much it ideally should be contributing to the total AP. So if you can give your inputs, how you want to build the business and how because now you are even applied for NPS license and NPS is going to form. So just wanted to understand how do you want this product to drive the growth and how any lever can come from this particular product from margin expansion point of view going ahead.
That's correct. I mean, this definitely is an area of focus, and basically you did participate in the call that we had done in the month of December to talk about Max Life Insurance's next 4 year strategy. You would have seen that this area is one of the most important areas. We are doing multiple things, so this is going to become, retirement is going to become a business unit within the organization. Currently, it is driven all through the channels. We are, of course, setting up the pension fund management business. There will be people dedicated to not just in our own channels, but also separately source annuities. We did start to focus on it earlier this year, actually the end of last year, and we have about 49% growth on our annuity business this year. If we were to look at 2 year CAGR, it is upwards of 100%. So we are one of the fastest growing over last 2 years CAGR on the annuity business, and we hope to accelerate this. We are, of course, late in the game. If you look at our overall proportion, it comes only close to 1% versus 3-4% for the large players. But we hope to catch up very quickly.
Got it. Thanks. And probably last one, the credit life we see it doubled almost in 9 months numbers year on year, from 26 odd crores to 51 crores. So still it remains a tactical call, or we have changed our focus to make it more of a margin driver or a core business to be part of the total AP in that sense.
No, like we have always maintained. I mean, rather than giving it any name of tactical, strategic, this is an important area for us, but we are selective about margin accretive business, and hence we will pick and choose. So we are not outlooking very significant growth in this area. We will only focus on those relationships which give us better margin profile.
Got it. Perfect. That's it from my side. Thanks.
Thanks, Sanket.
Thank you. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Good evening. Two questions. First, on again individual protection. If we see in terms of number of policies, almost it has declined by 30% in the first 9 months. Of course, the price hike. Now, again, going forward, because there's some sort of a price hike imminent. Now, what sort of growth you would see in maybe FY23, or you expect to see in terms of how this individual policy number of policy trend will behave, or you expect them to behave? That's one. And secondly, sorry, I joined call late. I'm not sure if you had it, but is there any update on the two fronts that 5%, I guess, that you have that option to buy from Mitsui Sumitomo, that stake in Max Life, and another is Axis Bank incremental. I mean, beyond that initial allotment, they had the option to go up to 20%. So what the status there? Thank you.
Well, Avinash, always a pleasure to hear from you, and hope you're doing well.
Yes, thank you.
Look at our individual retail business of last 5 years. We've grown over 49% year on year, and we have a very strong view on protection. Last 2 years were unusual, you would agree. The first year we were writing a lot of business, but came the Delta variant, and of course the supply side constraints emerged, because of which the number of policies actually went down. I'm hoping that in Q4 we will start to see growth, not just on the AP basis, but also on number of policies basis. So the big reason of reduction in number of policies that you see is only because of protection, and we are, like I mentioned to you, we are on growth path now. In December we grew on retail protection. So in Q4, I'm reasonably sure you will start to see growth on the number of policies. On the other two questions that you asked, as we mentioned to you, we have filed for approval, and that approval is pending with the regulator, and in due course we hope to receive the approval. Of course, the regulator has at this point in time his own timelines to approve it, and it is taking a bit longer, which I appreciate, and we are in touch with the regulator. We have responded to all the questions, so I'm very optimistic that it should come our way. On the other one, I think it's consequential subsequent to this approval. I think over next 12 months, further approval requests will be sent to IRDAI. So we are on the path to get the approval, and we will update you as and when we receive the approvals from IRDAI.
Okay, thank you. If you can just follow on the first again, because now the protection, of course, because of pricing catching up with, I would say, the mortality trend on the individual protection and prices going up. Do you incrementally see the behavioral aspect of customer changing as sort of again going more towards or demand for ROP product increasing? Because the ticket sizes of protection is increasing. So simply for risk cover, of course, ROP is of course that also has a higher premium for that return of premium product part. But do you see behaviorally sort of a demand for ROP increasing as the prices for pure protection is increasing?
So ROP, Avinash, actually offline channels typically are the ones which sell ROP in higher quantum, largely because it also optimizes for the ticket size for an offline incentive to be right for them. And given that in the first 6 months, 7 months, we were very cautious about protection business, and once the wave was behind us, we have started pressing the pedal on protection business. It will take some time for the offline channels to start picking it up. So till that time, the ROP business contribution will appear low, and Prashant indicated the ROP number at around 25%, which actually has come up a little bit, largely because a very strong momentum is being experienced in the e-commerce channel and the online channel, where ROP is not necessarily the favored product. ROP becomes a favorite product from an offline channel, and you will see once offline starts coming back in line, even the ROP contribution start increasing. So that's what I would say from a consumer. It's a bit of a both consumer and a distributor led play, which kind of causes ROP to kind of increase.
Yeah. Thank you. That's
Thank you. The next question is from the line of Harshit Toshniwal from Premji Invest. Please go ahead.
Hi, Amrit. Thanks for the time and thanks for the opportunity. Just two questions.
Sorry to interrupt you, Mr. Toshniwal. Your audio is quite low. May I request you to speak louder or come closer to the phone?
Is it better now?
Yes, thank you.
Yeah, okay. Just two questions, Amrit. Clearly, when we look at our business mix and possibly as we look at FY23, so one that ULIP is doing well at an overall level, and at the same point of time, just want to understand that so the non-par is now at a much reasonable mix of 20-25%. So wanted to reinforce and get your sense on the margin guidance that should 24-25 be a more sustainable levels on a medium-term basis. And second question is on the non-par piece. So if I'm not wrong, 1.5 years ago, we had a lot of unused FRAs, which gave us the benefit on the non-par with respect to margin. Just want to understand that is it that our construct and our FRA arrangements allow us to make slightly better than industry margin in that segment, say north of 30-35% kind of margin? Just want to understand is the product construct slightly different than what industry construct looks like?
Yeah. Let me first take the first question. On margin guidance, like I've been saying, our guidance will be anywhere between 25 to 26. While you see the ULIP mix for this quarter to be on the higher side, like always, we try to balance it, and you will see that happen. So it will be an optimal mix between growth and margin that we drive. My guidance will be about 25, 26, and as time passes over next 3 to 4 years, we do expect it to go upwards to in the range of 27, 10, 28% because we have huge aspirations towards growth, towards focus on protection, annuities. So we are anticipating that margin should trend up starting from 25, 26%. On your second question, I don't think there is any differentiation. I think most of the players in the market are working with FRAs. So the only delta that can emerge is your ability to negotiate and find the best rates and play with the margin. So we make reasonably good margin, which is what I can confirm to you on non-par book. I feel very optimistic, and we hope that if everything works well, we should be in the range of about 30 to 35% as a target. We could land up in quarters at around 25, but the target would be to be between 30 to 35%.
So just on one thing on the last piece of that. So that 30-35% margin on non-par, that's large. I think we had an advantage on the FRAs because I think in March 20, we had agreed on to a lot of FRA rates which were favorable for us and gave us the benefit for say over the last 1.5 years. So this 30-35% is sustainable even at a more normal level of operations and even if it's a flattish rate environment.
Sorry, Harshit, I didn't talk about margin as 35%. I said 30 to 35% of APE.
Okay.
That's what I said.
Yeah. Got it. Sure. Okay. This 25-26% margin, just out of curiosity, so in 9 months we are at 25%. Obviously, 4-2 is generally a ULIP heavy quarter for us again, going by the nature of the business.
Interrupt you, Mr. Toshniwal, your voice is breaking up. I would just request you to check on
that. Yeah, if you look at last quarter, it was a ULIP heavy quarter. We landed up with 29, almost close to 25. So we are hoping that it's quite real because in the last quarter, sales is also more, which gives you an advantage on better leverage. So hopefully we'll end up between 25.
Got it. No, got it. Thanks a lot. Thank you.
Thank you. The next question is from the line of Adarsh Parasrampuria from CLSA. Please go ahead.
Yeah. Hi, Prashant and team. Question is that just trying to understand the durations of product across the sector, right, which is non-par, more non-par, more par, on the longer duration has increased over the last 2-3 years, which obviously comes with higher margins as well. Just trying to understand, obviously you partly answered it in the non-par mix target that you have, but overall just wanted to understand how that plays out if you take the whole traditional business together.
So yes, I mean, basically, big hello to you, Adarsh, firstly. Basically, if you look at our target mix, we generally try for a 60% traditional, 40% ULIP. I mean, that will be something which is closer to ideal. I mean, better will be perhaps two-third traditional, one-third ULIP. In some quarters, it may go up or down. And within the traditional side, of course, it's a good mix of short-term and long-term. There is, of course, a desire to move more and more towards long-term, provided we manage the risk well. Definitely, that is kept in mind so that it's matched. But ideally, one would like to have a good balance between long-term and short-term. If you sell short-term a bit more, you're able to drive the business more, and you can get good growth because long-term actually requires the commitment to pay over a long period of time. So basically, it's always a right balance or optimal point that one is looking for between short-term and long-term. Yes, you're right. The long-term gives better margin, but at the same time, the risk management, hedging, etc., are instruments or mechanisms that one should always keep in mind.
And a related question, Prashant, is that given that the large mix shift between this long-term versus short-term happened in 21, and you did talk about, maybe investing in 22, but then recouping a part of operational efficiency and margins over 23 and 24. Where are we on that? So should one expect product mix margin improvement will be lesser next 2 years, but we'll be able to squeeze something on the OPEX?
I think we did squeeze a lot on OPEX last couple of years at an operating. Of course, there is an increase in OPEX that you see, but I can confirm to you that it's all variable to sales. So really at on-ground level, we have been quite tough on expenses. We have been trying to control the expenses quite considerably. Last year, definitely many things around compensation decisions, number of people deployed, etc., also helped us, and we are on that journey. I think if you were to look at us, our sales versus maybe top 3 players, there's a delta between us. If you were to look at our renewals versus top 3 players, there's a delta. So I think a large part of margin upside that we might end up getting will also be out of scale because the expenses are not going to, especially the fixed expenses, are not going to increase the same proportion. So when I mentioned that from a 25, 26% or maybe 25-ish% to 27, 28% journey that we should see over the next 3-4 years, that will happen maybe 60-70% because of more focus on annuities, riders, protection, and about 30% because of expense leverage that we might end up with.
Got it, Prashant. And maybe just one last question is, you did mention about what kind of protection that your sum assured you want to retain. But some of your peers have indicated about retaining like close to a crore and then after that reinsuring. I can spin it both ways. One way could be that there's an underwriting issue, and the other is that reinsurance are getting on the other side of pricing, and now the pricing is quite adequate. So do you think now, after all the hikes, or you have almost...
I'm so sorry, you're a bit fumbled. Others, do you mind just repeating your question?
Sorry. So yeah, I'll repeat. Just got off the speaker. So Prashant, what I was trying to say is one of the peers is saying that we will reinsure only beyond a crore, right? So I can, anybody can spin it both ways. One could be that there's a little bit of riskiness, hence you need to retain a little bit more. And the second aspect could be that overall the pricing of reinsurance has got a lot same. So, or on the other extreme, quite expensive. So I rather retain it in my books and it will be more profitable, right? So I wanted to check after this hike or whatever you're negotiating, are we it or there is more to come in terms of tightening?
I think this increase one has to see in two contexts. I think the first one was all of us were pricing very aggressively to start with a few years ago, 4 or 5 years ago. The island table that we'll use will be early 20s, that kind of a number. But as time passed, you'll realize that the kind of target segments that we were all going to, the mortality experience was a bit higher. Unfortunately, a big part of that burden was carried on or carried by the insurance providers. And then came COVID. And after COVID, there was further impact. Now, if you look at the insurance providers, I think the rate increase, they're trying to recoup some of the losses that they have had. But more so, it's tactical over 1 or 2 years. And we need to just include that and make that as a part. They will, of course, increase over a long period of time, but the way it will come in pricing will be far more moderate than the recoup that they're trying. Now, in that context, I think expectation of the reinsurance provider that you also take a bit more risk is very logical. Now, we, in our understanding, going up to, retaining all risks absolutely doesn't make sense because it creates huge burden on your capital requirement. It adds to risk. And, at the end of the day, it's a game of risk sharing. We are in the business. Customer is sharing risk with us. We share risk with somebody else. I think a marginal increase of the kind that we're talking about gives a good exposure to the outside party as well as retains some risk in our books. It optimizes for capital requirements. So I'm very comfortable and I'm of the opinion that as much as possible, one should share risk. I don't think by keeping too much risk in our books, there is a huge opportunity to make tons of money, because if that were the case, the insurance companies would be making a lot of money right now, which they are not. So I think what we are trying to do is find the right balance. Is the price increase? It looks like, basis on our experience, looks like. I think if things were to improve, which I hope it should, it may go down. So I'm just keeping my fingers crossed. It's a very long-term contract, to be honest, Adarsh. So we don't have experience of what will happen after 10 years and 15 years of somebody being in the book. We are just learning through it, but hopefully, I think we have hit the high point.
Got it. And the last one is, as an outsider, how do I track the underwriting experiences that the insurers are having with each company? Because eventually that will come to the fore, right? Today it's just about like where, as an outsider, I see it's an APE growth, right? But beyond the point, it's also a lot to do with underwriting. How are we placed basis how you would benchmark or the feedback you get from the insurers, and any way we can track this from the outside?
Yeah, basically 2 ways you could track. First, look at how the claims are. There's discontinuity in claims, and the claims are coming much higher. Then, of course, there is higher than expected run rate. So very crude way of looking at that. The other way is when companies talk about operating variances, you could dig deeper to find out the root cause. Really, operating variances come out of either persistence-related issues or claims-related issues. So that's the other way you could find out. As far as we are concerned, we are pretty comfortable. I think we all had a tough time, one-off, hopefully, to manage through COVID. So really, it doesn't make sense to look at operating variances or whatever over last 8 months, 6, 7 months. But hopefully, going forward, that could be one marker that analyst community in general could dig deeper.
Perfect. Thanks, Prashant. This is it, and thanks a lot.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity. Sir, can you speak about how the trends on the digital initiatives that we have put out and how the trends of the sales from our own website or from web aggregators that we have tied up?
So that's really one of the fastest growing area of Max Life Insurance. As you know, last quarter we grew a whopping 44% or maybe more, 70%. Okay, sorry, Nidesh, close to 70% year on year. So we are seeing tremendous growth there, not just from the aggregator platforms but onto our platforms also. So that's really doing wonders. We also took a decision, like we mentioned, we hold 30% of the market at this point of time on the aggregator as well as direct platform sales for protection. So that part is going really well. We also started in a small way selling savings and capital guarantee kind of designs. And very quickly, our share went up on aggregator platform, the largest aggregator platform, from 1% to 10%. So that entire part is doing very well. We are also, working on many initiatives and projects. You would have seen in media that we have come up with a very innovative solution for homemakers, a segment which was not catered to. So we are going to go. There are other plans of very innovative designs that are going to come up. So that part is working very well. And you may remember, Nidesh, that's one of the top priorities for next 4-5 years to grow that area. So we are well on that journey. As far as the other elements of digitization is concerned, again, we have made very good progress. There is work that we've done in the digital area for our agency channel. We have very recently launched a state-of-the-art activity management solution, which has also propped up our overall productivity. That is working very well. The total push towards cloud, we have moved and taken from maybe 18% to 39% over last 9 months. That's also worked very well. We have integration with Axis Marketplace, which is called Thanos. And that we are just trying to put more and more products on the Axis Marketplace, and that's another area of focus. We have within our HR area as well as investment area, we implemented SAP just now to take care of future growth. So there's 360-degree work taking place at this point of time around digitization, and hopefully next time we have a meeting like we did in the month of December, we will also update you as to how we are making progress.
Sure. And can you share what is the contribution of this channel to our overall APE as of now?
Okay. It will be a smaller number, to be honest. We do, we have done about more than 3,700 crore APE. So in that context, maybe 2-3%, perhaps, my sense, 3%. What is the number? We are just digging the number out. Just give us a second.
Sure.
What is the number, Nidesh? 4%.
4%. Sure. And on the operating expenses,
on VNB basis, it will be significantly more. We don't disclose margins at channel level, so I won't be able to do that. But it will be significant.
And then on the operating expenses, how should we think about from a next 2 to 3 year perspective? What portion of our expenses are fixed, where we will get the benefit of scale, and if you can quantify what could be the impact on our margins because of the operating leverage over next, let's say, 2 to 3 years?
So I think the operating leverage will come, but if we like we shared last time not in the analyst call, but separately as management, we are on a very expeditious, ambitious journey to increase sales on our e-commerce platforms, our own channels, through protection, annuity, etc. So I think next year is the year where we will have to make investment in people, setting up teams, enlarging leadership capacity, which will do that, maybe seek consulting help. So I think you will see some increase next year, but hopefully we do that and the same starts to come through. You will start to see operating leverage. So I'm saying over next 12 months, I won't give a picture that there will be a lot of operating leverage, but beyond of that, most definitely.
Understood. And then lastly, on the Axis Bank channel now, it is already a open architecture for last 2 to 3 years. So are we seeing how are the market share trends in that channel, and how are we preparing ourselves if they completely open up for the other life insurance company?
So it is an open architecture, and the open architecture is already with 2 other people along with us. So it's fully open architecture to the level of regulatory permissible number of players. And we have learned how to play in open architecture, which is great. But at the same time, Axis Bank, being our promoter and shareholder, is hugely supportive of all the aspirations that Max Life Insurance has, and will be working along with us to make sure that we continue to grow through Axis channel at a very healthy pace.
Sure. Understood. Thank you, sir. That's it from my side.
Unlike other open architecture platforms, the only difference that you have to keep in mind is there is a shareholder relationship, direct shareholding relationship also, which is not common with other open architecture platforms.
Thank you. The next question is from the line of Nilesh Jethani from BOI AXA Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question was on the protection side of the business. So I've been hearing from last now 2 to 3 calls that we are going slow on protection due to supply side pressure, testing, etc., not available. This quarter we saw around 11% YOY growth. So going ahead, are we seeing the supply side pressures taking a back seat, and protection individual can see a growth from here on, or still the policy remains same, we will go slow considering wave 3, etc., are still in transition?
No, actually the first one. Going forward, I think we have a view on Omicron, and we believe that it is not going to be, as negatively impactful for any kind of business, especially around protection. So we are very positive. We do want to grow. This is a specific area. So across all elements of protection, which is pure term, riders, health, we are hugely bullish, and it is going to be an area of investment in Max Life Insurance. So I must say, going forward, I am quite optimistic that we will start to see growth in that area.
Got it. And one question on the margin side I had. So you guided that we would like to be the VNB margins in the range of 25-26%. So the background from which I come from is ULIP, considering the strong equity market performance, will see a decent growth. Whether you try to pull it off or whatever it is, but we'll try, it will continue to grow. Interest rate expected to go up. So banking products may or may not, but in general case, they become competitive. So non-par will see some shakiness over there. So by and large, the low margin will see a decent growth, whereas high margin business may take a backseat. So what confidence it gives you to maintain that 25-26% VNB margin?
Yeah, I mean, if you look at our mix in quarter 2, we had a margin of 28%, which was more skewed towards writing for non-par business, which we rebalanced. And if you look at our mix in quarter 3, there is reasonable rebalancing that has taken place between ULIP and traditional side of the business. And despite doing that, our margin is about 24.9. So I think the business will work towards finding the optimal point between growth and margin. And I'm very hopeful that we will be able to hit the sweet spot with about, if we write too much of ULIP like we have written in quarter 3, maybe more towards 25, 24.8, those kind of numbers. And if we are able to balance it better, maybe towards 26. That's where the confidence comes from, because as every quarter passes, as you know, it's a seasonal business, so we do more and more sales, and that also has a benefit on overall leverage, and that also drives margin. So I'm very hopeful that we should be able to, on a longer period basis, which means about full year basis, maintain a overall profile of about 25-26.
Got it. And one last question on the online side. So we said that online is growing northwards of 50, 60, 70%. So wanted to understand, when you sell a term plan online, so requirement for testing, etc., are curtailed, or the conditions remain same, or do we have a policy of up till X lakh or X sum assured, we won't go for the testing, etc. So what's the thought process of that piece going 70% and?
Yeah, Max Life Insurance has 100% health checkup, 100%. So everybody who buys from us protection has to go through the health checkup. But what we have done is we have eased the journey, which means our ability actually to get the health checkup done, have the result come quickly, etc., is of a higher order. And I think that's the way we will go. That's the guidance also from the insurance provider. And at this point of time, we're not anywhere close to finding tons of flexibility around it, especially for high sum assured cases. So we do 100% test at this point of time.
Got it, sir. So those were my questions, and thank you so much for replying to all of them. All the best for the future quarters.
Thank you.
Thank you. The next question is from the line of Neeraj Toshniwal from UBS. Please go ahead.
Hi, my question is on riders. Just wanted to get some sense that from comparing last quarter, we have seen improvement in the rider attachment rates, and whether it is just setting in the protection, or also, as you mentioned, that launch with ULIP. So whether ULIP is also seeing the improvement with sale of riders, and whether our margin within that portfolio has increased specifically. Thank you.
Sorry, Neeraj, again, you were a bit fumbled. If you could just repeat, it will be better. I could sense that you're asking something on rider, but if you could say one more time.
Yeah, so hopefully it's better now. The question is on riders. So just wanted to get some sense on that. Our attachment rate is improving vis-a-vis last quarter. And whether we're just selling riders through protection, or also ULIP has some peakers within that, and whether our margin for that portfolio in ULIP has improved.
Okay, so if I got your question is where are we attaching riders? So riders are being attached all across. Actually, now our entire product portfolio suite is in such a manner that riders can get attached all across. So even in ULIPs, the riders are getting attached. But I must say proprietary channels actually have been far quicker to embrace it. And wherever the proprietary channel is actually attaching a rider on a ULIP design, there is a margin augmentation which is happening on the ULIP as well. But because the overall volumes are still low, from an overall margin perspective and VNB perspective, it's a small contribution number. But I think we are picking up good, healthy momentum. For example, for the last quarter, we have grown over 100% on our rider base. And for the year, we are somewhere around 45% kind of levels actually with respect to our growth rates also. So there is momentum that we are seeing, and slowly, some of those practices are also going to get shifted towards the non-proprietary channels.
Got it. Thank you. That is helpful.
Thank you. The next question is from the line of Harish Kapoor from IIFL Asset Management. Please go ahead.
Hi, thanks for this. Just a couple of questions. One is, your retention for the protection business has gone up from 20 lakhs to 30 to 35 lakhs. Could you answer that question in terms of sum assured? What is your average sum assured? What percentage of the overall business gets retained now compared to previously?
So our average sum assured is in the range of 80 to 90 lakhs. That's how the range has remained. Now, what Prashant mentioned is actually we are in the process of negotiating and in discussions actually. Today, we are retaining around 20 lakh rupees on our books. And in our negotiations with our insurer, this is likely to increase, as Prashant actually highlighted, earlier during the call, more in the ranges of 30-35% kind of retention levels.
So it will be broadly around 20-30% right now, the current number?
It is around 25, 25% current number.
25%. And if it goes to 30-35 lakhs, then that will become 35-40% of the business or higher?
It will be in that range, bit more. I don't want to give a specific number because it's still under negotiation.
Yeah, but you can just speak about range, should be fine. So it will be around 35-40 or 40-50?
No. So it will be lesser than 40, more I say anywhere between 30-40%.
The other part is just, you're talking about, margins for the business for maybe this year around 25-26. Maybe next year itself is in that range. So the growth from a VNB standpoint will broadly come from APE. So if you can comment a little bit around that, first is that December growth has been pretty strong for you and the industry as well. So how much of that growth has come from new product introduction, and what has been the approach there? Do you see growth again being strong in January? I do know that last month of the quarter is stronger and January is not really a comparable from a December number. But do you see growth rates good, and how should the year shape up? And maybe anything for next year as well, because when we look at your numbers, it's broadly been, in that 350 to 450 crore, number for multiple months during the year. So from June to November, so there is a lot of base which is favoring you. So next year, how do you see that growth? If you can just talk broadly, will be helpful. And even January, December.
I mean, it will be hard for me to give you a number, but I think we are, last 5 years, our growth rate, 5-year CAGR is 19%. We've grown last 5 years 19%. So one would look at accelerating that a little bit, and doing better than the 5-year CAGR. Quarters will go up or down for a variety of reasons, so I won't quite be driven. As far as this quarter is concerned, of course, we have had, January is because of Omicron variant, etc. We have seen impact on footfalls. We have seen impact on people falling sick. So we just need to see how January plays out. But one would work hard towards maintaining the growth trajectory and do well. Let's keep it at that level. But over a long period of time, like we mentioned in the month of December also when we met with many of you, we are outlooking robust growth of better than 5-year CAGR kind of a numbers over next 4 or 5 years.
Yeah, and can you just answer that question? In December, how much of the growth was from new product introduction?
I don't have those numbers. Maybe we could provide that to you separately. But we have two new products that we launched, one in non-par and one in par. But I must say a large part of growth also came from ULIP, which is not out of new products.
Sure. And last thing from mind is, your market share and Axis Bank channel, if you can comment on that.
Yeah, I mean, it goes up or down, but, currently closer to maybe 80%.
Sure. Great. Thanks a lot. Good luck. That's it from mine.
Thank you.
Thank you. Thank you. We'll take the next question, which is from the line of Ms. Jim Chawate from Kotak Securities. Please go ahead.
Hi. Most of my questions are answered. Just one clarification, and this was essentially on the rate hikes for protection policies. I think what you mentioned is that currently you are in negotiations with the reinsurer, and whatever is the hike that comes in, you will pass it on. You will fully pass it on to your customers. And I think you also kind of mentioned that you are going to look at increasing the retention rates. So does it mean that the overall margins of the protection business go up after this?
Yeah, I mean, one will try to, but at the end, it's a combination of many things, market forces, how much margin can we generate. But one thing is very sure that the margins are not going to get diluted from where we are.
Sure. And just one last, one more question is on the Axis Bank. I don't know if you mentioned it, but would you have some kind of a medium-term outlook or guidance from the bank in terms of where your market share would settle? I think you mentioned somewhere close to 80%.
Many times we don't even know the market share. So what I told you is my high-level estimate. What I can tell you is the growth journey that we have crafted for ourselves, which is a very strong growth overall as well as from banca channels, has been presented to the board. Most of the members of top management are there on the board, so we have a common understanding of and blessing from Axis Bank towards driving the growth of Max Life Insurance. And I think they're very optimistic that we will continue to get the support which is required to traverse this journey.
Sure. Perfect. Thank you very much and all the best.
Thank you, Nishin.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you. Thank you, ladies and gentlemen, for joining on Max Financial's earnings call. We look forward to such interaction in future. Wishing you a nice weekend, nice and safe weekend. Thank you very much once again.
Thank you. Ladies and gentlemen, with this we conclude today's conference call. On behalf of Max Financial Services Limited, we thank you for joining us, and you may now disconnect your lines.